Debt's probably the most simple form of business finance to talk about. Typically, this will be in the form of a loan. So let's say we'll go back to our business again and we'll say, we still need $400, not $200. So we'll take that out in the form of a $200 bank loan. So once again, our cash at the bank will now be $400, and we'll now have this liability on our books of $200, which we need then to balance up the balance sheet. Because I've kind of linked this cell with the interest cell, what this actually does in P&L income statement terms is a loan almost inevitably has an interest payment attached to it. And again, this comes out after our operating income. So, and it has the effect of reducing our pre-tax income, because everywhere I've ever been, interest expense is an allowable deduction against taxes. So in many respects, debt is actually a fairly good thing in corporate finance terms, because for starters, you don't dilute your ownership at the company. I'm still able to pay myself the full dividend. I'm not splitting it with anyone else if I don't have equity stakeholders. The only deduction on cash is simply the interest payment for that year. And at some point when I've got enough money in the bank, and realistically, if we look at how this balance sheet has kind of fed through, by the end of this year, I would be in a position to redeem that loan, because I still owe the $200 after I paid my interest, but I've got $486 in the bank, so there's nothing to stop me just redeeming this loan at the end of the period. So I make that zero. And of course, because I need to, I take that out of my bank account, so I then only have $286 left. So that's really how debt works. It's by far the easiest of the financing methods to understand. The only proviso that I'm going to make to that is when we talk about what I'd call a fairly complex financial instrument. And I'll give you an example. Let's go back to this and say that, okay, we're still going to take in a minority partner, and we're going to give him 50 shares, just like we did previously. However, he doesn't want to pay a premium for that. What this guy's actually saying is, he goes, I'll tell you what, I want 50 shares, but instead of you just sticking the 150 into a share premium account, what I want you to do is recognize that 150 as debt to me. So that might be a shareholder loan, let's call it that. And this can be this kind of thing really depends on where you are in the world and the actual legal treatment of certain things. So, for example, you could have a thing called a preference share, and a preference share is really a share that has a fixed dividend attached to it. So it might be a 5% preference share. So if the share is worth £1,000 or $1,000, you pay 5% of that, so $50 each year as a fixed dividend. These kind of things are a bit, I'm not going to go into much detail because it's so dependent on where you live, and there are a lot of kind of rules around things. So, for example, how you treat a preference share depends on whether it's a redeemable preference share. In other words, the company can basically buy that share back at any time, whether it's non-redeemable, so it's issued for good, whether there's a requirement to pay a dividend every year, so it's called a non-discretionary dividend, or whether it's a discretionary dividend. All of those things depend, kind of affect whereabouts on the balance sheet these things live. Now, fundamentally, they're all going to be in this section somewhere. They're all liabilities and equity, but whether it's kind of a subset of equity or a subset of liability doesn't really matter. It's just something to understand based on where you are. So really, all I've got to say here is, the simple kind of debt is essentially a loan of some description, but be aware that there are more complicated things such as preference shares or convertible notes or warrants or something else that is a kind of debt equity hybrid. But those are fairly uncommon until you start dealing with venture capital companies, and they tend to kind of quite like convertible notes, which are essentially loans that convert to equity at some point, because essentially that just lets them have their cake and eat it. But other than that, let's not worry about that for the time being.